Hello. Yes, good afternoon, everybody. I hope you can hear my voice and at the same time see my screen clearly. So today's webinar, I want us to look at a simple strategy. I want us to look at something which I've been working on for some times now, and it has been successful. I can say it has been successful, not entirely very successful, but it has been successful to a reasonable percentage. That is in a way that you could use it for your own personal trading. You may improve on it, or you may just use it as it is. So I use indicators on this one. I do use some indicators. One of them is already on my screen right here. So how it works is very simple. You need to go to a lesser, like the 5 minutes time, or maybe you could use it on any time frame, whichever one, 5 minutes, 15 minutes, 30 minutes, or even on the 4 hours time frame. You can still use it and understand that we are not in trades for a long time. This is like a scalping strategy. You're not going to be in a trade for more than 1 day, 2 days. You enter trades, and then when the trade goes into money, you just steps out. As long as you've recovered your commissions, at the same time you've gone beyond the current spreads, then you can't just step out of those trades. So I'm going to start off. The key is to know where we are headed, and then get into a trade when the price begins to do something opposite. So for example, if you have we take this as the highs, we take this as a high, we take this as a high, this is a high, we have a high, we have a high, we have a high, and we have a high there. And then we also have the lows, where we have this as a low, we have 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 a low, and there's a low here. Then currently there is a low which has just formed here. So the idea is to trade when we have lows that are getting higher, then suddenly the price breaks below those lows. That is, when we have lows that are getting higher, but the price breaks below those lows. Like here, we had a low at this instance, the price went up, it came back down, we had a low here, then it went up, it came back, then we had a low somewhere here. So you can do two things. If you understand clearly the concept of hedging, you could enter a buy here, same time you enter sell position. For the sell which you enter, your take profit is fixed at this level here, the instance when the price was touching this diagonal line, or at this point here. So you can buy it here, or you can buy it there, or if you buy it here, sorry, if you sell it along this line, then expect that sell to go up to this point or up to this point here. But if you buy it here, expect that buy to go up to the immediate to this level here. Does it make any sense what I'm saying? So you may use this as a reversal level. That is, when the price touches this line, you look for a buy position. There is no sell order. You strictly just look for a buy position. The same thing here. When you have a low, this price moves up, it goes down. Then you have a low which is higher than the previous low. Then when the price gets back the third time, you're supposed to pick a position. So this is going to be a good place to look for a buy from. So when you buy it there, expect that the price is going to continue upwards, at least up to the next level, which is this point here. Does that make sense what I'm saying? So strictly speaking, when the price touches this line for the first time, we're not doing anything. When the price touches this line the second time, we are not doing anything. As a matter of fact, when the price touches the first and the second one, that is when you're supposed to join the dots to make it a complete horizontal. So this is a buy, but we don't buy it. The only buy we pick is this one. Unfortunately, this has gone against us. So that's not a bad thing. It's not very bad if the price goes against you when you enter the position here. The idea is to be consistent. That is, when the price gets back, pick a position. So this is one approach. The other approach is when the price forms a low, a higher low, and it gets to that point, you pick a sell instead of a buy. Like here, we could have taken a sell here that has gone our way. Look at the same thing here. We had a low here. We had a low. The price has gone. It has gone down. In fact, has even gone much lower. This is also another one. The other one is this one. Here, we have this. So we have that one. We have a low, higher low. Then we pick a sell position. We have another one here. So it's like I've taken this in a rush because it's not very good. That's why you may enter trades at some time and then find that it's not going on as you wanted. That's no problem. If you enter the position, ensure you have your stop loss at the highest high between the current highest high and the previous one. So that means that the stop loss will be somewhere here. Here we have a low, higher low. We have a sell entry. Then we have our stop loss somewhere here. So we have a low, higher low. Then we enter the sell position. Our stop loss is here. You can see that the price has perfectly gone up to our profit. So the profit here could be either this line or this line. All of them have been taken out. There's another place here. So we have a low, higher low. Then there's a sell here. The price has gone our way. There's another one. So this one may not necessarily be a good one, but if you took a sell position here and you had your stop loss here, you can see that the price didn't even go up to it. Instead, the price went down. We have another one here. We have a support. This is a good place to look for a sell from. We could have taken that position, still that went our way. We had another high here. So this one lost a low getting higher. Then we could have taken a sell. This actually went up the stop loss. So the cases which I've looked at the moment, they're strictly sell cases. Let's look at the instance when you should be looking for buy position. So for a buy, you should look for cases where the highs are getting lower, then the price suddenly rises above the previous high. So rises above the trend line, which is formed by those two highs. So that would mean that we'll get this is an example of a high, a lower high. So we have this, a high, a lower high, we pick a position. That position means that the price is continuing upwards. The same thing we would do here. Would pick a high, a lower high, a high, a lower high. Then if the price was to break above it, then that could have given us the best place to look for a buy from. We have another one here. So we have a low. This is a high, sorry, a lower high. Then there is a break at this point. So this is where we could have taken a buy from. We have another one here. So this is a high, a lower high. There is a break. So this was a good place to look for a buy from. You can see that the price indeed went that direction. Then we had another one, this lower high. We had another. This is not a good one because if you draw your line like this, you can see that it actually didn't give you the correct place, the correct signal. So we could have taken a buy at that point. But if you took a buy, still it did went correctly. This is a high. It's not higher than the previous one. And then we have this. We have a high, a lower high, and there is a break. So we have another one. We have a high, a lower high, there is a break. So this right here, this could be a very good place to look for a buy from. If you took the position, you can see that the price actually went up to our take profit. So that's a good one. We have another example here. So we had a high, actually here, we had a high, a lower high, then the price attempted to break above it somewhere here. So that place could have been the correct place to look for a buy from, which is somewhere here. You took a buy there, you could have taken your profits here, but the price eventually went to the upper side. So this strategy, it looks like you will have very few trades, but most of the trades which you'll be having, they're going to be very profitable. Like here, we had a high, a lower high, then this is where you could have bought from. The other one, this is an example for a buy also. We had a high, a lower high, then we had a buy that is upwards. So you had a low, a higher low, could have had a sell here. This still could have gone our way. So you can see basically that anytime the price breaks below this trend line, it tends to go in that direction, at least for some few number of pips. So these are the few number of pips that I want us to be looking at, to be picking. When the price immediately it touches this line, this diagonal line, you're supposed to pick a position, have your stop loss above the high of this candle, then you get out once the price hits this level here. That's one example. We have another one here. This is not a very good one because actually it's a good one because if you took a buy here, the price went up to your profit, so you could have got out with some money. So we had a low, a higher low. There's a break here. You can see that whether the price indeed in concerning that. All the ones I've talked about, they are good ones. Don't think that they're not good. The fact that I've mentioned that you're looking at a good one does not mean that the ones which you've looked at are not good ones. Even those are good. We have this one. Look at this high. We have a high. We have another high. Then you could have taken a position here. Your stop loss will be somewhere here, but your take profit will be somewhere. So you could have had your take profit there. You had your entry there, and then you had your stop loss there. So as much as the price is upwards, this is a good place to look for a position up to this point here. Have your stop loss fixed at the low of this candle. And whenever you draw your lines and this diagonal lines appears to be too vertical, something like this, and you find that the candles that are touching it are somewhere in between, it's very good to ignore such a scenario. Such a case you're supposed to ignore. Or a case like this, no, this is a good one. We could have had a low, a higher low, could have taken a position there, but take profit is fixed at this line there. We had another good one here where we had a low, we had a higher low, then we could have taken a sell position. Our stop loss is fixed here. Our first take profit is this one, this level here. The next take profit is this one. So we could have taken a position just right when the price was touching this line up to this point. The next target is this one here. Does that make sense what I'm saying? So it should make a lot of sense if you just trade something like that. What I've noticed is people are looking for very complicated strategies. But from my experience, what actually works is something that is very simple. If your strategy is complicated, just know very well you're headed to the wrong direction. So what that means is if you can't explain whatever you're trading to a 3-year-old kid, it means that you really don't understand what you're doing. It means it's not good for you. Whatever is not good for a 3-year-old kid, it's equally not good for you. So when you don't have when you don't know exactly how to explain what you're doing, then it is good to either leave it or look for something that's very simple. We have this is a high, a lower high. You could have taken a position here. With this position, your stop loss is just a few pips. It's not very high. It could be somewhere there. So you could have taken a buy and then you stop out somewhere just 2 to 3 pips away from the point of We have another one here. This one, we could have had a position, could have had a high, a lower high, could have had a position here. That's gone straight up to our take profit. So that's a good one. We have another one here. This is a low, higher low. Could have taken a position. Your stop loss is fixed at the highest high. Expect the price to move in that direction. So in all these examples which we have looked at, you can see that with this indicator, just this indicator alone, there are many things which are in place, which if you just know how to apply them, you will get almost several trades successful. Because, for example, if you have this, a low, a higher low, then you pick a sell there, you can see what has happened. The price has gone in that direction. This was a good one. Then we have another one. This is a low, a lower, a high, sorry. This is a lower high. Then we've had a position here. You could have had your stop loss there. And then your first take profit is fixed on this chart here. Here. On the extreme edges. This is the take profit, the first one. We had the first take profit here. Then you have the next one. All of them, they've hit profit. So simply put, that is how I monitor this strategy. That is how I use it. I don't do a lot of analysis, no much analysis, because if you're a beginner, there is no point for looking for complicated things. Just look for simple and easy things that you really find more easy for you to explain to everyone. Then you can now follow them strictly. So if you can't explain it to a 3-year-old kid, then the whole thing is not also good for you. So that's why I'm using a very simple strategy. The indicator is there by default on MT5 or MT4. You can get it inside the navigator. It's already there by default, so we have it here. You don't have to get it from anywhere, just here. This is the indicator. It comes by default on the MT5, on the FreshForex MT5 and the FreshForex MT4. You just need to drag it on the chart and then leave it with the default inputs. So the default inputs then may not necessarily be the best for you, but they are good to some extent. Like this, all the setups we've looked at now, they were treated with the default settings. So thank you very much. That should bring us to the end of today's analysis, today's webinar. We'll meet again next week at the same time. Thank you and see you.